Okay, picture this for a second. The Nifty suddenly crashes 3% in a single day. Red tickers are literally flashing everywhere on your screen, panic absolutely sets in, and all of a sudden everyone in your WhatsApp groups is an amateur economist. But fast forward just 2 months later and boom, the index is casually sitting at an all-time high. And here is the brutal irony that plays out time and time again. The exact same retail traders who sold everything in a complete sheer panic at the absolute bottom, yeah, they're now rushing back in, desperately buying at the absolute top. Why does this happen over and over again? Well, welcome to today's Explainer, where we're going to unpack the one true edge you can actually have in the Indian stock market. Honestly, it's not some secret mathematical formula, but it is the one thing that decides whether you're actually going to make money or just, kindly donate it to someone else's portfolio.
Okay, let's dive into this destructive cycle. When you see someone constantly selling at the bottom and buying at the top, it's incredibly easy to just assume, oh, they just have a terrible trading strategy. But the truth, it's much deeper than that. This isn't a strategy problem at all. It's entirely a mindset problem. Look, you can have the most perfectly back-tested strategy in the world, but if your mind simply cannot handle the pressure of the live market, you're going to abandon your plan the second things look even a little bit scary. So we really need to shift our focus away from the charts on our screens and over to the psychology in our heads.
And I want you to really absorb this core thesis, because it pretty much dictates everything we're covering today. The market rewards behavior, not intention. You see, the market is a completely neutral entity. It doesn't know or care that you just started your SIP last month with the absolute best of intentions. It doesn't care that you took out a personal loan just to jump in on that sure-shot hot stock tip your cousin gave you. Good intentions absolutely do not protect your capital. Only disciplined, highly controlled behavior does.
Section 1. The market is indifferent.
And this brilliantly illustrates exactly what I mean. The market is neither your best friend trying to make you rich, nor your worst enemy trying to bankrupt you. It simply exists. It's completely indifferent to your personal financial timelines or your feelings. If we look at these major Indian market crashes, we've got the 2008 global financial crisis, the devastating 2020 COVID-19 fall, and the 2022 correction following the war in Ukraine. Indian investors have truly seen it all. But here is the absolutely crucial takeaway. Every single time, the market recovered. And tragically, every single time, a fresh batch of retail investors sold in absolute panic right near the bottom, locking in their losses literally moments before the rebound. The market just moved on, entirely indifferent to their panic.
Which brings us to Section 2, the two emotion traps.
So what's actually causing all this panic? Well, it comes down to this really fascinating duality in the amateur investor's mind. On one side, you've got greed. This shows up when, say, a random microcap stock runs up 5x in a single month. You see the rocket emojis all over social media, you feel that intense FOMO, the fear of missing out, and you jump in right at the peak because you just have to have a piece of the action. That's the exact frenzy right before a major correction. But then, on the other side, we have fear. This rears its ugly head when your portfolio drops 15% and literally every business news channel is screaming about a quote-unquote market crash. You get totally overwhelmed, you sell everything, and you turn a completely temporary dip into a permanent, locked-in loss that you never actually needed to take. Two totally opposite emotions, right? But they lead to the exact same result, losing money. So how do we actually fix this? Well, the real secret edge of a professional trader isn't some ridiculously expensive technical indicator. It's the practice discipline of emotional regulation. It literally means training yourself to act completely opposite to your natural emotions. It's having the sheer courage to buy when the fear around you is the loudest, and having the restraint to just sit still and do nothing when the greed and hype are totally deafening.
All right, Section 3, patience as a position.
Far too many people view patience as just a passive state, right? Like a simple lack of action. But in the market, patience is actually a highly active, strategic requirement for creating wealth. If you look at how real, generational wealth is actually built in India, whether it's a legendary long-term investor's portfolio or, your father's old LIC policies or those Reliance shares somebody bought back in the 90s, the journey always looks exactly like this. Long, incredibly boring years of absolutely nothing happening, followed by a sudden burst of massive compounding returns that make up for the entire wait. The catch? Most people just simply cannot handle those boring years.
Let's actually compare these two mindsets side by side. Take a look at the amateur trader on the left. Their focus is purely on chasing short-term momentum. Their primary action is just hyperactive, constantly switching stocks, always trying to find the next big winner. And their daily habit? Checking their trading app or their Nifty 50 index funds like 5 times a day. Now compare that to the wealth creator on the right. Their focus is completely on long-term compounding. Their action is enduring those boring years by simply holding on. And their habit? ignoring the daily noise altogether. If you're investing in blue chip stocks for retirement, I promise you the biggest risk to your portfolio isn't some sudden market crash. Actually, scratch that. The biggest risk is you, checking your phone too often and letting all that noise trick you into doing something foolish.
Moving on to Section 4, Process over Prediction. We really have to accept a hard truth here. Absolutely no one, not the biggest fund managers on Dalal Street and certainly not the loudest voices on FinTwit, can reliably predict short-term market movements. So the crucial point is you have to replace that desperate desire for prediction with a strict process. It's an unglamorous checklist for sure, but it works, and it's what separates consistent investors from gamblers. Step 1, have a clear entry rule. You need a logical reason for every trade, not just a hot tip from a random Telegram group. Step 2, a defined exit. You have to know exactly where you're going to cut your losses before you enter the trade, not after you're already down 20% and panicking. Step 3, position sizing. Never, ever bet the house on one single stock, no matter how sure the setup feels. And Step 4, a review habit. Journal your trades. You have to learn from your own mistakes so you don't repeat them. I know this isn't going to trend on social media, but this structure is what actually protects your capital.
And finally, Section 5, Zoom Out, the India story.
When you get totally overwhelmed by the daily chaos of those red and green candlestick charts, honestly, the most powerful thing you can do for your mindset is to just step back and look at the bigger macroeconomic picture. Let's move to and see how this builds a rock-solid case for long-term optimism. India remains one of the fastest-growing large economies in the world. We've got decades of formalization ahead of us. Rapid digitization is constantly expanding our markets, and it's all supported by an incredibly young, expanding workforce. And most importantly, when you zoom out, the Indian market has survived massive financial scams, global recessions, devastating pandemics, and some highly volatile elections, and yet it just keeps climbing. Yes, zoomed in on a daily chart, it looks chaotic, even terrifying. But zoomed out, the trend is incredibly clear.
Ultimately, it all comes down to this single choice. Which chart are you trading? Are you trading the daily noise that totally preys on your fear and greed? Or are you trading the long-term story that rewards patience and process? Your mindset is literally the lens through which you view the market, and it absolutely determines which of these two realities you're going to experience.
So I want to leave you with a bit of a provocative thought today. The next time the market swings wildly, and trust me, it absolutely will, I want you to just pause for a second and ask yourself, am I reacting to the price right now, or am I reacting to my emotions about the price? Asking yourself that one question consistently is worth way more than any hot stock tip or fancy technical indicator you will ever find. Master your mindset, and the market will take care of the rest. Now, please remember that all the information we covered in this explainer today is for educational purposes only and does not constitute financial advice. Thanks so much for joining me to unpack this fascinating topic.